The Bank of Canada dropped their policy rate today, but you already know that because if you follow one single realtor on Instagram, they've told you. So, realtors, thank you for your service. What often gets overlooked is that they also release something called their monetary policy report today. They do this on a quarterly basis. The last one came out in October of 2024. And I took the time to read through it so that you don't have to. Let's get into it. You can click into a PDF. They've changed the formatting. It used to be a lot sexier, but it's still pretty good. Their overview on economic activity is that GDP growth is estimated to come in just shy of 2% in the fourth quarter of 2024, which means that GDP outgrew population growth, and we should actually start seeing an increase in Canadian GDP per capita. Consumer spending per person actually picked up in the second half of 2024, which doesn't really allude to a recession. As Tiff Macklem mentioned in the last presser, he's not expecting a recession. I personally am, and I think most Canadians probably feel the same way, but the data isn't showing it yet. Residential investment, this one's important for the real estate industry. Basically, your real estate commissions and home renovations picked up in the last quarter of 2024. One of the biggest reasons for this is this idea of the HOPE acronym. The first thing to slow when interest rate hikes start is housing, and then you see people spending less money on home renovations, let's say decks as an example. So then companies like Home Depot are getting fewer new orders, and then their profits slow, and then unemployment slows. And so unemployment is the kind of the last thing, and we're seeing that now. But the inverse is true when rates start getting cut, is housing is the first to benefit, and then you start seeing a slow ramp up in, again, people spending money on home renovations, and then profits start to rise, and then employment starts to recover. And so right now, the fact that we are seeing residential investment beginning to recover, again, this is spending, this isn't prices, this isn't house prices growing up. It quite literally just means that more transactions are taking place. And you can see this ownership transfer cost is substantially larger than it was in Q3. New construction has been substantial because of this huge surge in purpose-built rental that we've seen taking place in the Canadian economy. Business investment remains subdued. The labor market remains soft. I think everybody is aware of this. We are seeing unemployment rate rising. Most of the hiring that we're seeing in the economy comes from government spending. The necessary employment growth needed to keep the employment rate constant is being lowered. Wage growth is moderating a little bit, which could have an impact on housing affordability in the long term, because housing affordability is not just a function of prices and interest rates, but also the incomes that Canadians earn to pay those mortgages and to pay for those prices. Inflation seems to be where they want it to be. I don't really need to add much more to that. This is why we're seeing them bring rates down, and it doesn't seem like they're worried that it's going to go up. The one funny part about inflation is they use this matrix to show which components of inflation are running high versus low, and they have shelter services and rent especially running exceptionally hot. Rent is actually not high on a year-on-year basis. Rents are falling. And the data set that the Bank of Canada is using to measure this rent inflation is likely lagging. Inflation expectations from consumers have largely returned to normal. So this is probably something that matters to them just as much as what inflation is actually doing, is what do people think inflation is going to be. Inflation psychology is a big thing with Canadians, where we tend to spend money if we think prices are going to go up and not spend money if we think prices are going to go down. They are expecting, as I mentioned at the beginning in their GDP forecast, that GDP growth per person is expected to pick up in 2025. And a lot of this is simply because even though our GDP isn't growing massively, it's still growing, and our population growth is slowing. Our population isn't necessarily shrinking. It could, but it isn't. But it's growing slower than our GDP per person. This is most commonly used as the standard of living metric by the OECD. And so Canadians might actually feel some relief because there'll be more economy per person over the next couple of years, even though we're in a recession. GDP growth is projected to rise above potential output growth. Consumers apparently plan to increase their spending. I haven't spoken to any of those consumers, but allegedly that's what they got from their consumer expectations survey. They do expect residential investment to continue to grow through most of 2025. So again, this is your real estate commissions and your home renovations and new construction. Into 2026, it'll settle a little bit. The GST HST holiday from from the federal government has added some volatility to near-term inflation. I think everybody would have imagined that that would be the case. CPI inflation is projected to remain around 2%. So it sounds like the Bank of Canada is confident that their work with the hiking cycle is done and that they're not worried about a return of inflation. The U.S. economy growth obviously remains strong, and so they do show how the Canadian dollar has become really weak relative to the US dollar, but not so weak relative to other currencies. So basically everybody's been devalued relative to the US dollar. And so, the Canadian dollar has great buying power in Europe. This might just mean that you have to take the kids to Disneyland Paris rather than Disney World in Florida in 2025 and 2026 if the US dollar remains so strong. You can see this reflected in bond yields where bond yields in the US have risen and bond yields in Canada have fallen. And the Canadian dollar is depreciated against the US dollar, but remain more stable relative to other currencies. They do acknowledge here the risk of tariffs, and they mention that significant increase in tariffs together with retaliation would have a substantial negative impact on economic activity in Canada. At the same time, inflation would likely increase due to higher costs of imported final and intermediate goods. In the face of a trade conflict, main upside risks, government spending could be stronger. You do see this political business cycle where you get politicians starting to spend a lot of money, wanting to spend a lot of money heading into an election. The federal government is now saying that they would plan to do pandemic level relief for workers and businesses if Trump imposes tariffs. We've also seen governments in BC and Ontario say the same thing, that they would basically be hitting pandemic style relief. So the government spending, the writing is on the wall, right? Bank of Canada did say that they ended quantitative tightening today. So probably the next step really is turn the printer back on, more quantitative easing, more government spending, more devaluation of the Canadian dollar. And that's probably a lot of people talk about whether or not there's a bull case for Canadian real estate. Honestly, the bull case for Canadian real estate is the Canadian dollar is worth absolutely nothing. If they can keep devaluing CAD relative to USD and other currencies around the world, and if they're committed to doing that, then that really would be what would boost asset values. It's not going to come from any organic growth, income, etc. It's going to come from the value of a dollar being diminished through more and more of this relief. And I honestly think that the U.S., Trump probably would be happy with that outcome, seeing the USD continue to be strong relative to other global currencies. They also have details of variations on different trade conflict scenarios based on what they would expect to be an outcome. They have a scenario in which it increases Canadian inflation, and then they have a scenario in which it reduces Canadian GDP growth. They acknowledge that the Canadian dollar has depreciated and uncertainty in Canada's economy has increased significantly since their October report. Increased concerns of future depreciation of the Canadian dollar, like I just mentioned, in the markets. Basically, the markets are pricing in the Canadian dollar will continue to fall. And again, it's not just Canada seeing this. Pretty much everyone has seen depreciation against the US dollar. So relative to the rest of the world, Canada isn't faring so bad. Relative to America, it's a bad situation. And that it's difficult for us more than everyone else because the only country that we share a border with is the US. Our biggest trading partner is the US. So it's logistically expensive for us to capitalize on the fact that Europe has lower buying power against the USD and we want to start trading with Europe. Well, now everything has to go across the ocean. And it's just slightly harder than driving it across the border. Slightly more expensive than driving it across the border. Anyway, I hope this gave you a little bit of insight on what the Bank of Canada is thinking and the risks heading into 2025 for Canada's economy.